Pleasingly, over the last quarter, distributions have actually been better than previous quarters over the year, and with the majority of funds paying distributions. We're certainly not back to pre-pandemic levels, so we know that there are challenges for retirees in regards to income payments, but it is the nature of the environment that we are currently in that is sort of putting that pressure on income returns at the moment. The lower for longer interest rate environment that we have been experiencing even prior to the COVID-19 crisis has really put pressure on the equity component of portfolios to be the main provider of income returns. So following on from the crisis, companies were less likely to pay dividends because they wanted to sort of keep that cash to protect themselves from any future shocks that we saw, like a coronavirus type shock. And so companies weren't paying dividends, and therefore income returns were lower in that component of the portfolio, alongside the already low component on the fixed income side. So generally in Australia, dividends are actually paid twice a year. So you have your interim dividend paid at the half year, which is in March, and then you have the full year dividend, which is paid in September. So just by that very nature, you're going to see those two quarters pay higher dividends. And typically the September quarter dividend, which is the final year dividend, is actually higher than the March. So typically September quarter is the strongest, but this year we have seen December actually be the strongest off the back of the crisis. So at the start of the coronavirus pandemic, interest rates were already at a historic low. So in order to try and mitigate the economic impact, central banks across the globe further reduced cash rates to historic low levels. So that will further depress income levels, certainly in the short term. Cash and bonds are struggling to sort of produce any meaningful return. So it's sort of really putting pressure on that equity component of the portfolio to generate the returns. We tend to try and encourage beneficiaries and our clients to look at their portfolio from a total return perspective as opposed to just an income return perspective, because there will be different times and points in the cycle where capital returns are above income returns and vice versa. So by looking at a portfolio from a total return perspective, we certainly think that that can help beneficiaries understand that certain market environments will produce lower income returns and certain market environments will produce higher income returns but lower capital returns. So we do view the outlook to be quite optimistic. We certainly have seen a pickup in distributions over the last quarter of the year in 2020, and business confidence and consumer sentiment is starting to increase in Australia. So we anticipate that income returns are likely to at least remain at current levels, if not increase marginally over the next 12 months.